For decades, nearly every drop of Canadian oil exported ended up in the United States, a cornerstone of North American energy security. This relationship was so deeply entrenched that it seemed almost unbreakable, with pipelines and trade agreements binding the two nations together in a web of mutual dependence. The U.S. relied on Canada for a steady, affordable supply of crude, while Canada counted on its southern neighbor as a guaranteed customer. But in spring 2025, everything changed. Canada began shipping more seaborne crude oil to China than to the U.S. For the first time in history, the Pacific route overtook the traditional southbound flow, signaling a dramatic reorientation of Canada's energy exports. This wasn't a fluke. It marked a historic pivot, driven by new infrastructure, trade wars, and a deliberate Canadian strategy to break free from U.S. dependency. Years of planning, investment, and political will had finally paid off, opening the door to new opportunities and partnerships across the Pacific. In April 2025, Canada sent 299,000 barrels per day to China, surpassing the 286,000 barrels sent to the U.S. by sea. These numbers, while close, represent a profound shift in the direction of Canadian energy exports and the country's economic future. While most Canadian oil still travels south via pipelines, this symbolic shift signals a monumental change. It's a clear message that Canada is no longer content to be a junior partner in North American energy, but is ready to play on the world stage. For Canada, it's a strategic triumph, finally able to access Asia's vast markets and diversify its customer base. This new access means greater leverage, more competitive pricing, and a chance to shape its own economic destiny. In Washington, the news landed like a shockwave, forcing a painful reassessment of the U.S. Canada relationship. American officials, long accustomed to energy security from the North, now faced the reality of a shifting alliance and new competition for resources. The shift is about more than oil. It's about sovereignty and Canada charting its own course in a turbulent world. It's a declaration of independence in global trade, and a signal that Canada is ready to navigate the complexities of a multipolar world. This new chapter is just beginning, but it's already rewriting the rules of global trade and power. As Canada's oil flows east, the world is watching, and the consequences will ripple far beyond the energy sector, shaping geopolitics for years to come. The catalyst for this dramatic shift in Canada's energy landscape is the Trans Mountain Pipeline Expansion, or TMX. This ambitious project represents years of planning, investment, and debate, and now stands as a testament to Canadian engineering and determination. Completed in May 2024 after years of construction and regulatory hurdles, TMX tripled the original pipeline's capacity, connecting Alberta's vast oil sands directly to the Pacific coast. This expansion was not just about increasing volume, it was about opening new doors for Canadian energy on the world stage. Now able to carry an impressive 890,000 barrels per day, TMX has transformed Canada into a major maritime energy player. For the first time, Canadian oil can reach global markets efficiently, bypassing previous bottlenecks. Before TMX, Canada's oil was largely captive to the U.S. market, often sold at a significant discount due to a lack of access to overseas buyers. This limited Canada's economic potential and left producers vulnerable to U.S. demand fluctuations. With TMX now operational, tankers line up at the Westridge Marine Terminal, shipping hundreds of thousands of barrels daily to Asia and beyond. This new export route is reshaping trade patterns and strengthening Canada's ties with global markets. This expanded capacity made the pivot to China and other Asian economies possible, providing a reliable, long-term route for large volumes of oil across the Pacific. It's a game-changer for Canadian exporters. TMX's success has reignited debate over other pipeline projects, as Canada eyes further expansion and weighs the balance between economic growth and environmental responsibility. More than just steel and concrete, TMX is a symbol of Canada's energy independence, global ambition, and the country's evolving role in the world's energy future. TMX enabled Canada's pivot to Asia, but it was the Trump administration's aggressive tariffs that made it urgent. Since Trump's return in 2025, sweeping tariffs on allies and rivals alike created instability, forcing Canada to seek new partners. The turning point, a 35% U.S. tariff on Canadian goods in August 2025, exposing Canada's vulnerability. Ottawa responded by accelerating efforts to decouple from U.S. economic influence, especially in energy. The global trade war frayed alliances and made market diversification a necessity, not a choice. Ironically, U.S. protectionism pushed Canada to fully leverage TMX, forging a powerful new bond with China. The energy map was redrawn by political decisions in Washington, not just market forces. One of the great ironies of the U.S.-China trade war is how it led to America's near-total exclusion from the Chinese oil market, a market that had once been a beacon of opportunity for U.S. producers. Just a few years ago, American crude was flowing steadily to China, fueling a surge in exports and optimism across the U.S. energy sector. But China's swift imposition of a 10% tariff on U.S. crude made American oil instantly uncompetitive, erasing what had been a booming export business almost overnight. The tariff not only raised prices, but also sent a clear signal that China was ready to look elsewhere for its energy needs. By the summer of 2025, not a single U.S. crude tanker was headed to China, a stark and dramatic reversal from the previous year when American oil was a staple at Chinese ports. The once busy shipping lanes between the two countries fell eerily quiet. Meanwhile, Canadian oil, tariff-free and newly accessible thanks to the completion of the Trans Mountain Expansion (TMX) pipeline, quickly became China's preferred alternative. Canadian producers seized the opportunity, ramping up exports to fill the gap left by the U.S. The Trump administration's hardline strategy backfired. Instead of pressuring China, it opened the door for Canada to fill the void, fundamentally shifting the dynamics of North American oil exports. American oil companies lost access to a massive and growing market, while Canadian firms gained unprecedented access and record profits. The shift was felt not just in boardrooms, but on the ground, impacting jobs, investments, and entire communities. The situation also exposed America's growing dependence on Canadian heavy crude, especially as sanctions and geopolitical tensions cut off other major suppliers. U.S. refineries, built to process heavier grades, now relied more than ever on Canadian imports. With Canada now able to sell its oil to Asia, its negotiating position with the U.S. has never been stronger. Canadian producers can now play both sides, leveraging new markets to secure better deals at home. The U.S. can no longer take Canadian supply for granted, forcing policymakers and analysts to confront tough questions about the nation's energy security and future supply stability. This dramatic shift has upended long-held assumptions about who depends on whom in North American energy and has redrawn the map of oil trade across the continent. Canada's newfound leverage is changing the balance of power, giving it a stronger voice in energy negotiations and policy decisions. The consequences of this realignment are rippling through both economies, affecting everything from trade balances to energy prices, and reshaping the future of North American energy for years to come. TMX and the pivot to Asia have ushered in a new era of prosperity and influence for Canada. For years, Canadian oil sold at a steep discount due to limited buyers and pipeline bottlenecks. Now, with access to global markets, that discount has narrowed dramatically, boosting profits, government revenues, and jobs. This economic windfall gives Canada greater political clout and independence on the world stage. Ottawa can now push back in trade talks with the U.S., confident in its alternatives. Revenue from oil is helping cushion other sectors hit by U.S. tariffs, like lumber. The energy pivot is creating a virtuous cycle, strengthening the entire Canadian economy. Canada is no longer just an appendage to the U.S. economy, it's an assertive middle power. The country's resilience is earning it new respect globally. For China, Canada's emergence as a major seaborne supplier is a strategic win. China has long relied on the Middle East and Russia for oil, leaving it vulnerable to instability. Adding Canada, a stable neutral G7 nation, diversifies China's energy sources and reduces risk. As U.S. crude became subject to tariffs, Canadian oil via TMX was the perfect substitute. Chinese refiners moved quickly to secure long-term deals, forging a new partnership. The influx of Canadian crude is also pressuring traditional suppliers, giving Asian buyers more leverage. This shift subtly alters the global oil market, reducing OPEC's pricing power. For China, the new oil corridor is a quiet but profound geopolitical win. The flow of Canadian oil to China has strained the U.S.-Canada relationship. The US long viewed Canada as a secure, captive source of oil, a pillar of its energy security. Now, Canada's ability to sell elsewhere has shattered that assumption, forcing a painful re-evaluation in Washington. The Trump administration's leverage over Canada has diminished. Threats of tariffs or pipeline closures have lost their sting. American refineries, especially on the Gulf Coast, need Canadian heavy crude more than ever. With Canada able to sell to Asia, US refiners may face higher prices, costs that could hit American consumers. The old model of taking Canadian resources for granted is over. A more collaborative, respectful partnership is now required. The sight of Canadian oil tankers sailing for China is a wake-up call for US policymakers. Canada's Pacific export route is sending ripples across the global energy market. Asian refiners, once reliant on the Middle East and Latin America, now have a stable, non-OPEC alternative. Middle Eastern and Latin American producers face new competition, forcing them to be more competitive on price and terms. The influx of Canadian crude is eroding OPEC's pricing power in Asia. Supply chains are being reshuffled, creating price volatility and a more fragmented market. Canada's oil offers a buffer against disruptions in volatile regions like the Persian Gulf. The TMX pipeline is a new global energy artery, adding resilience to the system. The world's energy map is being redrawn with new lines of supply and influence. Canada's pivot to China is a signpost for the future of global energy and trade. The old world of predictable alliances is fading, replaced by a more fluid, pragmatic landscape. The TMX pipeline's success will spur more projects as Canada seeks to expand its Pacific gateway. For the US, this moment demands a strategic rethink. America. First policies have had unintended consequences. Rebuilding trust with allies like Canada will be essential for US interests. The Canada-China oil connection is a lesson in modern power. Infrastructure is destiny, and market access is sovereignty. Political decisions in one nation can create opportunities for others, rapidly realigning global relationships. The great game of global energy is changing, and the board looks nothing like it did a decade ago.